KCAA, the Inland Talk Express.
Welcome to The Mortgage Voice with Jeff Barton, your voice in the mortgage industry. Each week on this program, Jeff and his guests share their expertise, personal anecdotes, and the latest industry news to keep you in the loop. Now, to provide you with insight and help you navigate the consistently changing world of real estate lending, here is your host for The Mortgage Voice, Jeff Barton.
Welcome, everybody. I'm Jeff Barton, your voice in the mortgage industry. 888-713-2929. That's the telephone number. Pick up the phone, give us a call. We talk mortgages on the show. As everybody who listens to the show each and every week, I want to say hi and thanks for tuning in once again. We provide solutions, answers, maybe bring up some points that you might not have thought about, and certainly those who do listen in the Inland Empire at KCAA, KMET, the Roadrunner, and of course up in Northern California, Nevada at K-Tahoe. I want to say hi to everybody in those locales. We can be seen on a number of different ways, or rather in a number of different ways on a number of different channels. I guess the most prolific one is themortgagevoice.com, but you can also see us on YouTube, Facebook, and a number of other sites. Our email address is info@malibufunding.net, and our website for Malibu Funding, which is the company that serves as the sponsor for the show. I want to thank you to those nice folks. Not easy to come up every week, each and every week, with the funds to be able to put the show on. And so having done that and for a number of months, years. Daryl, how long have we been doing this now, just you and I?
This would be show number 120, so about 2 years plus.
Two and a half years.
104 would have been 2 years.
Yeah, that's unbelievable. Okay, so we've got a number of these shows under our belt, and as I say, it's exciting, and I enjoy doing the show, and I enjoy bringing these types of interviews and answers to all of your questions. I'm Jeff Barton, again, the Mortgage Voice, the host here. And let's get into news to use right away, because there are a number of things happening right now, and we are in late May in 2018. A couple of things that are going on with the CFPB, with regulations, with the Senate, with the Congress, what's happening here locally in California, and some of the programs for down payment assistance in Riverside and San Bernardino counties. Anybody who's looking for more than just an FHA loan or a 3% loan, who wants a down payment assistance programs, there are some terrific programs, CalHAFA being one of them here in California. And if you actually need more assistance than that 3% that you have to bring in, call us or call your mortgage professional. They are county-wide, they're statewide, and if you're in beyond California, there are certainly plenty of programs. There's a great one out in Nevada that brings more than just the 3%. You could probably pay zero down and 100% loan if you qualify for these particular programs. The DARPA program, down payment assistance programs, as I said, CalHAFA, all of these require an income not to go above a certain amount, and loan amounts not to go above a certain amount. As everyone knows, FHA itself is the type of program that is 3.5% down, and then you get your loan. There are insurances involved in paying for that loan. Obviously, during each and every month, you have to come up with that insurance payment, and also there are other down payment assistance programs in San Bernardino and Riverside. Like I say, give me a call, 888-713-2929, and we can help you do that. I want to talk about credit card delinquencies right now, as well as some of the other things that are happening. We're seeing a bit of a disturbing trend across the board when it comes to payment of debt, whether it's short-term, long-term, car loans, or mortgages. I don't think it's alarming in terms of what we experienced in 2008. Let's be realistic. Those numbers were off the charts, and probably we're not going to see again. The reason being is that, yes, regulations did come in. Now, with regulations came a cost, and we'll get into that shortly, but the credit card delinquencies are up when it comes to the U.S. debt. The U.S. households they're doing pretty well these days. Stable amounts of debt, low delinquencies in general. But when it comes to credit card debt, the rising interest rates have started to pinch some households. Now I'm reading an article by Ethan Wolf-Mann from the favorite website that we go to for all our information, Mortgage News Daily. The percentage of credit card debt that is in delinquency has risen by about a percentage point from this time last year, from 5% to 6%. Now, that doesn't sound a lot until you consider how many people live by using their credit cards and their credit cards alone. Now, if we have 6% delinquency this year versus 5% last year, okay, that's not bad. Let's compare it to 2008 when you were having 30 to 50% delinquency rates on credit cards. People were living month to month on them, just paying minimums just to try to stay above water, make minimum payments, make the mortgage payments, trying to put bread on the table. There was a lot of issues back in 2008. But with credit card debt comes a mentality, right? I need it now, I want it now, and because the way economies work, if you're in a business, I was just reading recently about JCPenney, about some of the other large box, what they call big box retail stores, and what they were talking about in terms of their rebranding strategy, closing stores, more online, really puts people at risk who work for those companies. So if you're in a situation where you've just gotten laid off, and yet you are still maintaining a lifestyle and using your credit cards, yeah, that's the type of person that we're talking about. The employment for most people is really tantamount and really important in terms of planning out how you pay your credit card bills. You obviously have your rent or your mortgage, you have your food, you have other debts that you must pay, your electric, your car note, whatever it is that is right there in front of you, like I say, your electric, your phone bill, your cell phone bill, the car payment, the mortgage, the rent, what else is in that? But after that comes your credit card bill. Now, most people understand that if you want to get a mortgage, you have to have your credit card bill under a certain percentage every month in order to get the best credit rating. We've always talked about the 30% rule. 30% of your minimum, of your maximum amount that you can borrow, that's what you have to have on your bill. Meaning that if you have $1,000 that you're available to borrow, you can only really have $300 a month on your bill. That's 30%. That will give you the maximum credit score and also allow you the greatest amount that you can borrow. But a lot of people have not been doing that, and this all goes back to employment. As employment changes from, let's say, a big box retailer, or let's say a warehouse store, although if you're a warehouse worker, there's a lot of work out there right for you now. Amazon or some of the other larger retail stores that are strictly online, Amazon, obviously, eBay, a couple others that I can't think of right now. Barnes & Noble certainly has gone that way. We even see Walmart going that way, and they've made a huge push into trying to expand their online presence because they know that the stores that they have out there, that the way that retail has been for years and years, and everybody knows this. If you're out there listening right now, you're going, yeah, we know this. But the proof is in what I'm talking about when in regards to credit card debt. If you're driving your credit card debt up, it's because the employment that you have had is not as stable. So you need to begin to look at where you're working as a way by which you can prevent any long-term stress on your credit cards, on your credit, by getting into an employment situation that has more stability long term. And I say this a lot to millennials. I say, look, what are you getting into? What kind of job? I have a son that just graduated college, and he had a job selling door to door, and he went to work for a couple of weeks. It wasn't for him. Now, I don't know anybody who was around in the 50s. Well, there was a lot of door-to-door salesmen in the 50s. Vacuum cleaners comes to mind. I personally, in the 90s, sold door-to-door encyclopedias, Britannicas. Did you do that too, Darrell?
I bought Britannicas.
Right.
But my father sold Kirby vacuum cleaners in the late 50s, early 60s.
That's right. Now, the last time we saw somebody door-to-door anywhere in this economy was never. You just don't see these kind of jobs. So obviously I've advised my son that the best thing to do would to get into something. I mean, if you're going to do sales, you need to get into something that people really buy a lot of. Phone sales. If you want to go to work for AT&T and sell phones at the store, probably a pretty good idea. Why? Because everybody wants a phone. Computers? Probably not so much. Tablets? Yeah, people buy a lot of tablets. Anything that has a remote has some kind of Wi-Fi attached to it and can be easily and readily available for anybody under 30 years old to look at. I walk down the street, I walk down a mall, which really another dying institution, malls in America. So the point here is not about my son and his employment woes, but it's about the credit card that is creeping up in terms of the balance of the debt of households in America. 6% delinquency rate doesn't sound like a lot, but 1% increase year to date is a lot. And these are trends that are a problem as I see it moving forward, because employment can easily be reversed if people stop spending money. And if people stop spending money, it's because they don't feel good about the economy. The sentiment survey that comes out once every 6 months has just been out or is about to come out. I think it's a Michigan survey. Anyway, I'm Jeff Barton. I'm your host for the Mortgage Voice here on KCAA, KMET, the Roadrunner, and K-Tahoe. And we'll be right back.
You're listening to The Mortgage Voice with Jeff Barton. We'll be right back with more in just a moment. For more information on today's topic, email Jeff Barton at info@malibufunding.net. Now, back to The Mortgage Voice with your host, Jeff Barton.
Welcome back, everybody. I am Jeff Barton, your voice in the mortgage industry. 888-713-2929. That's the telephone number. Pick up the phone and give us a call. We talk mortgages, we talk lending, we talk money. And if you're in a need for any of that, we certainly can help you. I know there's a lot of pressure on people nowadays because lending's tight, refinances are down, a lot of mortgage companies out there who are looking for your business. I just want to make sure that when you are out there looking, make sure that you interview 2 or 3 people. Just don't go with the first person on the block who says, yes, I can help you. The reason is because there are many things in the mortgage, in the lending, in the refi business that unless you're educated, you can get taken. So this is a friendly word of advice to anybody out there who's listening. Shop around, find your best deal, and then commit to a particular lender. There are certain lending, I guess, issues and things that come up from time to time, and we're really happy to have on the show once again a guy who can provide a lot of business capital experience and money to those businesses that do need, as well as some other lending experience. I want to welcome back to the show Reed Blake from Business Capital Experts. Reed, how are you?
I'm doing well, thank you, Jeff. It's a pleasure to be back on.
Thank you very much. And I want to have people know exactly what you do, because I think it's interesting, especially in the entrepreneurial world, and people need money to start a business or to grow a particular business. Can you just give us an overview of what you do and how you help people?
Yeah, in a nutshell, we primarily fund via business, and we split business between basically 2 groups or categories. One is unsecured cash funds, and the other one is your asset-based or your secured funds. And we're very, very popular. We do an extremely good job in the unsecured space. We help people acquire unsecured cash, business lines of credit, unsecured cash loans, and we have just a huge volume of folks that come to us for that. Separate apart from that, we do asset-backed stuff. You know, we'll do $15,000, $20,000, all the way up to $30, $40 million on residential, commercial, industrial on the real estate side. And then we do other kinds of business as well. We do, we've done trucking companies, restaurants, yoga studio in Hermosa Beach. I never knew there was so much to know about yoga, Jeff, as I did when we did that one.
You know,
yeah. And you know I don't have exactly a yoga body.
No, yes, you do. I've seen many a yoga person with your exact size, so no, don't say that. Hey, listen, interesting thing about what you do is providing, I guess, financial solutions for people who are looking to grow their business. That's primarily your motive behind this, right?
Yeah, that's a really great way of putting it, yes.
Okay, and when you do this, qualifications are easy or not easy? I mean, let's say again, yoga studio, let's go back to that. I'm a guy, I live in a certain city, I want to open a yoga studio, I have some experience, but I need $50,000. How would one go about doing that?
Yeah, what we do is, again, we divide it in half, and we say, okay, what can we do cash-based wise and with on the unsecured side? So on the unsecured cash business lines of credit, you know, we're extremely successful there. 80% of our clients, again, this is round one. Round one typically takes between 20 and 30 days.
Okay.
We know in 7 to 10 days what a person's going to qualify for and how much they're going to get, et cetera. But typically speaking, about 80% of our clients obtain somewhere between $50,000 and $100,000.
Okay.
And so that then solves the challenge for that particular yoga studio owner, if that makes sense. But
Yes,
these are
it does.
unsecured cash loans, and they're in the business name. So again, they're tied to the EIN, not the Social Security number. And the qualification criteria for these, at least in the first 1 or 2 rounds, are very, very simple. Number one, you have to have a business. I mean, they're business lines, not personal lines.
Right.
Number two, let me back up. If a company has a history or a track record with the credit bureaus, business credit bureaus that track cash-based funding, i.e., TransUnion and Experian, then the qualification criteria is a little bit different. Oh, and by the way, of those two, Experian's the big dog.
Okay.
I mean, no questions about it. Experian on the personal side has a FICO score,
Right.
350 to 850.
And that's for the
business side, they have
business,
what's called-
right? That is a business.
So that's their personal one.
Oh, I
Business
see.
one's
Okay.
Is called the IntelliScore.
Okay.
IntelliScore. So mortgage folks are used to dealing with the FICO,
Yep.
things like that, and that's what people are doing. On the business side, it's called an IntelliScore. So absent a score with, say, TransUnion, on the business side, then what the unsecured funding sources do is they look at the prospective client or the business owner's personal. And so when they look at credit, here's what's kind of a little bit different. It is not a score-driven product.
Okay.
It's a blemish-driven product. So again, this is going to sound weird, counterintuitive initially, but there are such things as good blemishes and bad blemishes, and they are different based upon the file. What might be considered a good blemish for you, Jeff, would be a bad blemish for me.
Okay.
And so, that's how, for example, we had a client come in, their score was 777,
Right.
and they had 2 of the, quote, bad blemishes. We pivoted them into credit optimization. 30 days later, we brought them back in. They had their $50,000, $60,000, $70,000. Another lady came in, her scores were in the 640s. So, again, by definition, there's going to be some blemishes.
Blemishes, absolutely.
But she didn't have any of the bad blemishes. She ended up with tens upon tens of thousands of dollars, literally inside 30 days. And she was able to do what she needed to do. She had a contract with the NFL.
I see.
Super Bowl back in Phoenix. So again, it's not a score-driven product. So we ask clients, don't make decisions based on what we're saying.
And to
But-
figure that portion of it out, that's why they would have to come to you, because that sounds like I guess a formula that is not really that easy to understand, because as you're talking about it, I'm thinking, as a mortgage guy would think, I'm thinking, no, that doesn't make any sense. But as you're saying it, obviously you know what the formula is, so to come to you would be the best way to figure out what your credit score actually means in a business line of credit.
Exactly. Again, because it is counterintuitive, and for most folks, it's outside of their experience. They
Right.
haven't been exposed to this stuff before. I mean, technically speaking, small business owners, small office, home office kind of business owners, 98, 99% do not have an IntelliScore.
Right.
They may have been in business for 10 years, and they don't have that because no institution has ever extended them credit, cash-based credit, exclusively in their business name, and so therefore there's nothing to report.
Right, I see. And you would have to have partners who are in, I guess, that line of credit business to another business reporting that information, right? You may be in that business, but they're not reporting. So that requires a lot of, I guess, dedication. And, I mean, how many of your, what is the percentage of the people that actually have that kind of credit score to begin with when they come in the door?
It's funny because it's all over the map.
I see.
It's really crazy because, again, not being score-driven, it's blemish-driven. But I could safely say if we just went across all industry platforms with whom we work, I would say about 50% of the people are eligible day one for round one.
Okay.
The others we work with. It's not like we just say, oh, sorry, good luck, goodbye. We're not like a traditional bank in that sense. We'll sit down and we work with them. So if there's any one of the eligibility requirements that they're not able to meet, we work. They have an account executive that just literally holds their hand. We hold people's hands literally for 2 years through this process. So at the end of 2 years, they have somewhere between $500,000 and $2 million of unsecured business lines of credit, cash-based, and unsecured cash loans.
Now,
And unsecured cash loans are more of a traditional underwrite.
I see. Okay, very good. Do you also do, let's say, take money out of a guy's house to, I guess, promote his business or to push his business? Do you do those kind of loans as well?
No, we don't.
Okay.
Yeah, we're not in We're not in that space.
So if somebody had a lot of equity in their house, they would obviously go to somebody else in order to take money out to fund the business. That's a
Right.
whole different end of the business.
Yeah, they need to go to a. Well, yeah, let me back up. That's not 100% true. What I just said.
Okay.
Typically, they go to a mortgage broker.
Right.
A great company like Malibu Funding, and do a refi. If it's an owner-occupied refi, it's a little bit. We're really not in that space. If it's an investor who's doing investment properties, yes, we can pull money out of investment properties
I
to
see.
fund whatever they want to do, but we're not in the personal residence business.
Okay, this is just scratching the surface of all this, and there's a lot to talk about. Quickly, give me your favorite client to work with, the favorite type of client to work with. Is it a problem-solving client, or is it somebody that walks in the door and you just say, hey, this business is going to boom, let's get the guy the money? Who do you like to work with?
It's interesting that you phrase it that way. And let me answer two ways, two answers. Number one, we like to work with people who are fun to work with, in the sense that they're focused, they're engaged, they want. I mean, they got a vision and a mission, and they want to achieve it. They've got goals.
Right.
Whether they're a neophyte in their industry or an experienced pro. The second type is if you were to look at a criteria with clients. Obviously, we'd love someone to come in that had scores of, say, 680 or higher, no blemishes, or 650. I take it back, 650 or higher, no blemishes.
Right.
But again, that's few and far between. As long as they'll work with us, i.e., follow directions and follow them on time, we'll get them where they need to go. With us, it's never a question of if; it's a question of when. But again, it's so much more fun to work with people who are aggressive,
right?
Who want to achieve. Those are the folks you love to help. I mean, It gives us a lot of satisfaction to help that person move their dreams forward by giving them access to cash-based capital they otherwise don't have access to as a small business owner.
Reed, thank you very much. Real quick, 10 minutes. Thanks very much for coming on the show once again, and I want to have you back because this is the type of time of the year where people really want to expand their business or grow their business or start something exciting. Thanks very much for coming on the show.
Jeff, thank you. Once again, it's an honor to be on. I'm just grateful for the opportunity to visit with you.
Great, thank you. This is Reed Blake from Business Capital Experts. I'm Jeff Barton. I'm your voice in the mortgage industry, and we'll be right back.
You're listening to The Mortgage Voice with Jeff Barton. We'll be right back with more in just a moment. For questions or comments, send emails to info@malibufunding.net. Now, back to The Mortgage Voice with your host, Jeff Barton.
Welcome back, everybody. I'm Jeff Barton, your voice in the mortgage industry, 888-713-2929. That's the telephone number. Pick up the phone and give us a call. We talk mortgages, obviously. That's the name of the show. We try to look out for your best interest, and there are a lot of people out there trying to grab your money. There are less loans today than were done a year ago, so there's a lot of demand on mortgage professionals to get your business. So be very careful, shop around, look at what you're doing before you do it. A couple of things that I wanted to talk to our next guest about, having to do about how people wrangle you in, how they grab you, how they entice you to use them. And of course, this is Debbie Harris from Pi Media, our social media expert. Debbie, how are you, first off?
I'm awesome, Jeff. How are you? Thanks for having me on again.
Thank you very much. I always go to you. There's so much going on in social media in terms of what's right, what's wrong, how do we use it, can we trust it? Give us your just general impressions about what's going on either with Facebook or LinkedIn or many of the other, Snapchat, Instagram, all these social media sites, which are, I guess, coming under fire, maybe rightfully so, for the lack of security or at least the selling of your information. What are your general thoughts on all of that?
And I should say all that in about 2 minutes.
Okay.
I'll try. First of all, it's no surprise that the industry is going through some changes, and it's really no surprise that Facebook is really leading the charge in that regard. And you and I were talking offline. You know, Facebook's running that commercial now. They've obviously spent money to get the public to understand that they're making some changes. So I see that as a positive.
Mm-hmm.
And I understand, my partner told me about a week ago that Facebook actually deleted over 500 million fake profiles.
Wow.
So And for your listeners out there, when you go to a profile and there's really nothing on it,
Right.
let's say it's a man's profile and the only thing on there are pictures of women scantily clad that look like stock photos,
Right.
things like that are signs that you may be dealing with a fake profile, or it's somebody you know and actually their identity has been hijacked and someone has set up a fake profile with their face and their name. And this happens. It's happened to all of us. So I guess what I would say is I love social media.
Right.
I think personally and professionally it is going to continue to be a major part of our lives and our business lives and the way we deal with business. You know, you have to be careful with anything. Emails get hacked. We've
Right.
seen the biggest companies have data breaches. So I think it's good. I think it's good that the industry is maturing and there are changes that need to be made, and they are willing to make them, and Facebook would naturally be the forerunner as it is really the largest social media platform. And I do believe that Zuckerberg will make the necessary changes. And, yeah, you do need to pay attention to what you're looking at. Some of it is BS.
Right.
Some of it is just people spreading rumor. Double check with a few sources, and some of it's just common sense.
Now, in our business, a lot of people use Facebook to promote themselves, whether it be in real estate, whether it be in mortgages, anything to do with sales in our business. A large percentage of it is driven through Facebook. It just seems to be the way a lot of business is done. However, in that, we've run into some issues verifying people or employers, in that there are a number of fake sites up there, a number of fake people up there who are still promoting themselves in the business, either to steal identities or to try to get people to give them information that they can later use as a way by which to either deceive or do harm. And so how do we guard against that, other than paying attention? Is there some...
Well, yeah, I mean, I think you just have to pay attention. I mean, just in the last couple of weeks, I've received a call from an IRS person that there's a problem with my taxes. Today, I received 3
Right.
phone calls until I blocked it from a robocall telling me there was a problem with my Social Security.
Right.
I mean, we get it through the phone, we get it through email. An IT professional I talked with the other day told me that now what's happening is they're getting so clever that they're actually mimicking your client or your vendor or your professional, and the email looks like it's coming from them,
Yep.
and there's some kind of an attachment. So when it comes to social media, as I pointed out a minute ago, just, step back for a moment. If you're looking at a profile that doesn't have a lot of information, it doesn't have a contact phone number, you can always Google a phone number. That's how we found something for a client of ours.
I see.
You can Google a phone number and see what comes up. If there isn't a legitimate email address, if you just get the feeling that, you know what, this doesn't look right. And another thing, don't click on anything.
Right.
If there's a link in it, don't click on it. If you want to reach out to the person because you want to do business with them or you want to get more information, there should be an email.
Right.
There should be a phone number, particularly in your line of work, Jeff. I mean, you want people to pick up the phone and call you. Same thing with real estate.
Well,
so I think you really need to be aware.
Right, that's the real issue for me. I mean, obviously, I would prefer everybody just pick up the phone and call. I shout out the phone number on the radio show all the time, but predominantly, I get contacted through social media. And so we're dealing generationally as well as, practically. Most people just don't have the time to pick up the phone, especially when they know they're going to get, inundated with questions about who they are, what they are. If people, go on, I'm sorry.
No, I was going to say, if you want to reach out, and I did this just a few minutes ago with a hospital here, my father was having an issue. If you want to reach out, use a Facebook private message. And please, everybody out there listening, a Facebook private message doesn't mean that somebody else can't see it. Everybody at Facebook can see it.
Right.
But send a private message. Ask for an email address. Don't give personal information. But yes, I get contacted all the time through Facebook, through Twitter, through Facebook private message, Facebook comment. But you should be able to judge in that conversation if you're dealing with a legitimate person such as yourself, Jeff, or something is weird about the responses I'm getting, something is weird about the profile, if you have any indication whatsoever that it's not legitimate, go to Google. Put a Google search in, see if a website comes up, see if anything else comes up. Go to Yelp. Yelp is very strong. Go to Yelp and see what's going on. I mean, do a little bit of homework.
Right.
Same thing you would do when you see the new, you know, it's the old story. You're standing at the checkout counter in the grocery store, and there's the Inquirer. And, you know, it amazes me still to this day. It's the same thing. We would look at it. We wouldn't necessarily believe it.
No.
But for some reason, when people see it in social media, it's the gospel. So
I agree.
You really need to take it that next step.
Okay. Some of the exciting things that Facebook is doing, what are they doing that maybe is new, exciting, something that we can grab a hold of? Some of the products that they're coming up with, some of the ways to communicate maybe a little bit different?
Well, one of the things from a business perspective is, you know, the ability to move that banner. You can put a slideshow up now on your banner, so it makes it a lot more interesting. They are cracking down on the fake profiles. Now, Facebook has raised their price. There's no question that if you're boosting something, boosting a post, which I still say is the best bang for your buck on the internet, it is more expensive than it was, significantly more expensive, but it's still incredibly inexpensive when you think of doing Google AdWords or even LinkedIn, which I'm not saying don't do LinkedIn. It has its purpose, but it is more expensive than Facebook. So I would still say keep doing those posts, keep using video. Only now studies show us that video should be 15 seconds or less, no more 30 seconds, because apparently our attention span can't even go 30 seconds
Really?
anymore.
15 seconds, okay.
15 seconds, and those are the kind we create for clients, you know, cute little animated things. But use video, keep it short.
Right.
Make sure you're still hashtagging. Make sure that, you know, you're still hashtagging a subject that someone might search for on Google in your post. Make sure you see what's trending. If you go to Twitter on any given day, or you just put a hashtag trending in Google, I mean, you know, all the different holidays, hot dog day, pizza day, whatever it is.
Right.
These are all conversations from a business perspective that you can pull in. A good example was National Spinach Day about a month ago for our clients. We did some things with Popeye.
Oh, that's funny.
So, yeah, I mean, you know, I say have fun with it. Be careful with it. If you own a business, if you're a professional like yourself, Jeff, you cannot not use the digital world.
Right. Hey, shout out your phone number, will you, for Pi Media and yourself, so that those listening rather than viewing can get a hold of you, because all of this information is great, and I think there's a great audience for it.
Well, I'm actually going to give your listeners my cell phone number.
Oh.
It's 702-465-4082. Again, that's 702-465-4082. I'm Debbie, DEBBIE, at PImedia.me. PIMEDIA.me. PImedia.me is our website.
Thank you very much once again, elucidating what we need to know about what's going on in the digital world, especially when it comes to social media. Thanks, Debbie. I really appreciate it.
You're welcome, Jeff.
Thank you very much. And that's Debbie Harris from Pi Media, and I'm Jeff Barton, your voice in the mortgage industry. We'll be right back.
You're listening to The Mortgage Voice with Jeff Barton. We'll be right back with more in just a moment. For questions or comments, send emails to info@malibufunding.net. Now, back to The Mortgage Voice with your host, Jeff Barton.
Welcome back, everybody. I'm Jeff Barton, your voice in the mortgage industry. 888-713-2929 is the telephone number. Pick up the phone and give us a call. We're talking all things mortgage today. We're talking purchases and refinances. We get into a lot of the different things in the social media aspect of what's been happening, both at Facebook, LinkedIn, a couple of the other sites, to try to sell properties. I know there's a lot of realtors out there who use social media extensively and exclusively. I think it's a great idea, and I think that in doing so, what we do is expand what we try to do into a personal space way, and I think that's probably pretty good for the industry. I know I get bombarded a lot by emails daily on my inbox because I'm in the business, but if you're out there right now and you're shopping for a home or you're trying to sell a home, this is a great way to meet and interview people for that particular aspect of what you need. With us right now, again from San Francisco in the Bay Area, is Julie Peisner, and she works with Keller Williams up there. Julie's been on the show many times and is our expert. And Julie, how are you, first off?
I'm good. I'm sorry. Today is broker tour, so
Okay.
I'm in my car.
Oh, that's great. As a matter of fact, it's interesting you say that. Explain a little bit about what the broker tour is for people that just have no idea what you're talking about.
Well, it's not just for brokers anymore.
No.
But it's basically, well, what it used to be a day where all of the new listings would be open to brokers and agents to preview for their clients. And we would go, check out several properties and narrow down or see if they would fit for certain clients, and then bring those clients back to the open house or schedule a private showing for them if we thought that they might like it. And I would say for the most part, it still functions that way. It's mostly a day where agents go out and check out the inventory.
Right.
But in San Francisco, as I'm sure it is in most places, it's open to anyone.
Right. So anybody driving by, right?
Yeah, and especially now when people have much different work schedules than they did, in a different era.
Right.
Now lots of people, especially in the Bay Area, they work from home, they work remotely, and so it's nice to have a day during the week where you can just pop in and pop out of places. And also, the way that the broker tour is set up starts at 8 or 9 in the morning and ends at 2 or 3 in the afternoons, and it covers the whole city, each area having its own time frame, whereas if you're trying to go see 10 properties within 2 p.m. to 4 p.m., it's
it's really difficult. No, I agree, and it is also a little bit different than the open houses that they have on the weekends, right? I mean, this is a midweek open house, and that's today being a Tuesday. So, down here, well, it depends on the area. Some are Friday, some are Thursday, but...
Well, and ours is split because the city is so big that they actually, it used to always be just Tuesday, but now there's part of the city actually is on a Wednesday because there's too much to cover.
Right. Okay, I've been talking a little bit with another guest today on the show about social media. Do you use it? And I'm sure you do. And how much of your business comes from Facebook or Instagram or Snapchat or LinkedIn? How much of this is using to promote properties and how much is used to attract customers?
Well, I think the reality is that if you're not on social media, people are going to look you up just to find out, about you. And it's just like when you're looking at somebody's profile on LinkedIn. When I get a client, I immediately do that to see, okay, what kind of more information can I find out about them, where they work, or something like that, just to get a sense of their background. And so I think that having social media pages is important because it acts as a virtual business card for who you are. It's a fancy brochure. It doesn't often get business per se. I would say most of my business comes from repeat clients, referrals. I do a little bit of advertising, but I would say that the social media platforms are just additional resource and, like business brochures. But I think it's important to have them. Absolutely.
Hey, do you consider social media advertising per se? Because I know that the Board of Realtors does, and certainly CAR does.
Yeah, you absolutely have to have your license number on them and, all the rules. I'm just saying I don't think, like, that I very rarely get additional business just from somebody going to my social media page. I use it. I have a business page on Facebook. Right, me too. And so whenever I have a new listing, I will put it on there. Some friends will share it. It definitely, and I've done the boosting on Facebook and I've definitely advertised on there just
Sure.
to get more, people attracted to my listings.
Right.
But I don't use it as a tool to get new clients per se.
I see. Okay, give us a little update on what's happening up in the Bay Area, certainly San Francisco. What's hot, what's not, what's expensive, what's cheap? Well, nothing's cheap, but you know what I mean. I mean, let's be real.
Well, I'll tell you, deals can be had in certain places, but it depends on, what you consider a deal.
Right.
I think that not much has changed in the single-family home market, meaning it's still very hot. Anything in the $1 million or less market is still very competitive and usually gets bid up. I think the place where the market is soft is in newer construction because it's very high end.
I see.
We're talking like
2 million plus?
Well, I usually price it by square foot. So
I see. Okay.
13 or 1,400 square foot.
Yeah, that's expensive.
It's a lot.
Yep.
And where, some other parts of the general area might be 1,000. So it's pretty pricey, and there's a lot of inventory in the South of Market, South Beach areas. So I will give you a case study. I have clients who have a beautiful, new construction, it was built 2 years ago, condo that they paid dearly for 2 years ago when they moved here from New York, but they're now relocating back to New York for work. And, I was very honest with them, and I said, I don't really think you're going to make your money back. I mean, you'll be lucky if, it's only been 2 years. This is not...
Right.
Not everybody makes 20% every year.
No, it's 6% a year. That's what it's been going. So, you got to pay commissions. You got to pay closing costs. Sure, you're not going to make your money back.
People
Right.
are a little bit spoiled in San Francisco, thinking that this just appreciates, exponentially, but it doesn't.
No.
And so they were very reasonable, and they understood. So I put it on the market slightly less than what they paid for it because, we still need to make our listings very attractive
Sure.
to the market. And it sold in a week, and they got pretty much exactly what they paid for it. So, after commissions and taxes, it is a little bit of a loss.
Sure it is.
But it's still, we still found a buyer within a week.
That's really good. I mean, is it in a desirable area?
Very. It's right by the ballpark.
Oh, yeah. I love that area. Yeah. No.
Brand new.
Mm-hmm.
But, they were at least, they understood that they weren't going to, make hand over fist over it. But there are, so I'd say that middle to high-end part of the condo market probably softened a little bit.
Okay. And what's that price range again?
Like 1.5 to 2 or so.
Okay. And that's for what, 1,000 square feet?
Yeah, most new construction places are on the smaller side.
Right.
Your average one-bedroom being like maybe 700 square feet, and
right.
a two-bedroom being about 1,000 or
maybe
so.
1,100 or so. Okay, yeah, no,
Yeah.
that, wow, it's really amazing. Although there are some other places here in Southern California, they're really kind of catching up with what those prices are as well. I was really pretty surprised. Even in a small town like Malibu, the average price is now $6 million a house. So that's.
I know it's well, you got location there.
True.
And and that's part of the reason why San Francisco is crazy, because there's not too many places where you can still build.
Right. Oh, no, absolutely not. I mean, hey, listen, we're running up against the clock. Can you shout out your phone number, Julie? Because anybody who's looking up in that area, San Francisco, they need to talk to you.
They do.
They do. Yes, they do.
It's 415-823-0824. You can also text me.
Okay, great. Right quickly before we go, where do you think we're going with prices? Do you think they're stabilized finally?
I really do. I mean, like I said, with the exception of, the kind of the entry-level single-family home market, And you know what? Also, I'll say as the last word, we're coming up in the later part. I mean, in San Francisco, it slows down a little bit in the late summer.
Right.
But then we're coming into, those midterm elections that everybody keeps talking about.
Yeah.
So, it'll be interesting to see what happens.
Julie, thank you very much for coming on the show. I always enjoy talking to you, and great update. Thank you.
Thanks so much.
Thank you very much. And that's Julie Peisner, and she works for Keller Williams up in the Bay Area. I'm Jeff Barton, your voice in the mortgage industry, and we'll see you next time.
You're listening to The Mortgage Voice with Jeff Barton. We'll be right back with more in just a moment. For questions or comments, send emails to info@malibufunding.net. Now, back to The Mortgage Voice with your host, Jeff Barton.
Welcome back, everybody. I'm Jeff Barton, your voice in the mortgage industry. 888-713-2929. That's a telephone number. Pick up the phone and give us a call. We want to help you decide what you're going to do with your purchase this year. Maybe you want to refinance. And by the way, refinances are extremely down. I mean, if we're talking 65% less refis done this year than last year, that's about what it is. So a lot of mortgage brokers, a lot of mortgage lenders are trying to figure out a way to up the volume of mortgages that they're doing. I just read an article that said that Wells Fargo is actually jumping back into the FHA game. Now, why would they do that? Because can you imagine the overhead Wells Fargo has? Drive around any city in the United States, any town, any small hamlet, you're going to see a Wells Fargo bank. Imagine that overhead every month, never stops. The overhead for not only the space, but the people. Yeah, Wells Fargo wants to get back into FHA. Now, they say it's because they're trying to figure out a best way to mitigate loss and risk. FHA has a lot of different rules and regulations, and it's a federal, obviously guaranteed loan program. It's not guaranteed, it's insured. So the guidelines to be able to qualify for the mortgage require a lot of regulation and a lot of quality checks, and obviously that drives cost up. And I was telling one of my colleagues yesterday about just a simple thing that would drive, just as an example of why it drives cost up. Okay, so we do a thing called Fraud Guard. Now, Fraud Guard looks at every bit of a loan file, and you, by nature of how you choose on a menu about what you want to have seen in terms of a report of whether this is a risk factor or not a risk factor, things like your credit score, your verification of employment, your verification of deposit, all of these things, which means your bank deposit, where you work, your social security number, all the things that you put down on your loan application, this Fraud Guard product looks up and checks on it, because let's face it, you could put anything down there unless somebody's watching. How do you know? And we've talked about fraud on the show several times, and we don't need to belabor the point, but obviously everybody in the chain here relies upon this information. So let's just go for the fact that if you use Fraud Guard, it could cost anywhere from $20 to $50 a file. Let's say for the general, now that doesn't sound like a lot, right? But who's going to pay for that? Now, Wells Fargo will do 1 million, let's say they do 1 million loans this year. 1 million times $50 is $50 million. You don't think that drives cost up? Now, for my company, we'll do, 400 or 500 loans this year. But 500 times $50 is, quickly? Yes, exactly, $25,000. Now, that doesn't sound like a lot, but for a small company, that is a lot. And that's just one aspect of what you have to do for FHA in terms of regulatory requirements that drives the cost of the loan up. So when Wells Fargo, the CEO, comes out, Dimian, says, hey, we are exploring ways to drive the cost of the loan down. What they really mean is regulatory relief. Now, there's a lot of regulatory relief right now coming out of Washington. The CFPB director, Mulrooney, has come out, and he is trying to actually reverse a lot of what's going on in terms of regulation. There was a bill before the Senate last week that passed and went to the House, which, now, when 2008 rolled around, there were a lot of things called stress tests. There were a lot of things that were implemented on lenders, local, and this all had to do with your net worth in terms of when certain regulatory issues took place. For instance, if you were an institution, a lender, a bank that had $50 billion in assets, certain regulatory things kicked in. And as I talked about in how cost is driven up, well, just a simple thing like fraud guard, if expanded over the whole portfolio of your loans, well, if you were a company, a loan company, a bank, a lender, and you had $50 billion in assets, a certain regulatory implementation kicked in, which meant that you had to be spending more money. Well, they've just passed in the Senate and in the House regulatory reform, which changed that particular monetary threshold to $250 billion, which means that we went from 36 national lenders to now 12 that have to implement a certain level of regulatory compliance, which means that those other companies that don't have to do it anymore just got regulatory relief, which means that the cost of lending to you will go down. Now, I'm not advocating an open playing field and an unregulated marketplace. I'm just not that kind of guy, because I know the way people are, even in my company, which is, as I said, we'll do 500 loans at Malibu Funding this year. However, even in a company my size, regulatory relief means that we can offer more savings to clients, more compensation to loan officers, thus relieving them of the necessity to try to get a loan done that necessarily they might or should not be doing. All of these things are mixed with the need to watch the store, i.e., if you're going to leave your store and you own a store and you leave the cash register open, guess what? Somebody's going to take the money. It's just the way it is in life. If you are not watching, somebody will take advantage of you. It's happened to me locally at a small level. It's happened at medium-sized company and certainly nationally, as we've seen the greed does not know any size nor boundaries. However, regulatory relief is needed. So there is a fine line? No. Really what it is the common sense approach. We're not in the same regulatory environment needed as we were in 2008. We're just not. We want to make sure that we don't get to a point where you're saying to yourself, hey, should we really be doing no income, no asset loans? Should we really be doing stated loans? Should the federal government really be buying these type of loans? Well, that's where the QM, non-QM, CFP directions from Dodd-Frank are still here. But when it comes to regulatory relief to relieve financial pressure on institutions, as I said, we are doing less loans today than we were doing last year or the year before. So we're going to see a lot of contraction in the business this year. Now, is that a good thing? Maybe it is a good thing. Maybe we should do with less choice in the marketplace. I personally don't think it is, but without the product available, i.e., if the federal government through either FHA, Ginnie Mae, Fannie Mae, or Freddie Mac does not expand the QM pool, i.e. the qualified mortgage, you are going to find that the contraction in the industry is obviously going to happen, and a lot of companies will go out of business. But if we combine that with regulatory relief, those that are left will be able not only to survive, but also to thrive. Anyway, I'm Jeff Barton, your voice in the mortgage industry.
You're listening to The Mortgage Voice with Jeff Barton. For more on today's topic, visit www.malibufunding.net.
KCAA Loma Linda, 1050 AM, 106.